Disclaimer, this is a really long video talking about different types of investing. So the best way to get around this video if there are certain parts that you're not interested in is just by skipping ahead. Here we start. If you want to learn how to invest, then you've come to the right place. Today I'm going to show you exactly and step by step the 4 best methods to invest. And together we'll be going through all the fundamentals of investing. And I'll be sharing with you also how over the last 4 months I was able to double the money I invested, and then I tripled it, and finally I quadrupled it, all in the short space of 4 months. And if you follow through the video, then I can guarantee you that you'll be able to do just the same. Now, the only thing holding you back is yourself. So carry on and push yourself to learn. And while you watch this video, be sure to pause it and take down some notes if you need to. This is really something that's going to encourage you to remember anything you learned from this video, and will help to keep the ideas on. Just to give you a brief summary of what I'm going to be teaching you in this video. Now, the first part of this video is going to be teaching you about investing and what it even means to invest. The second part of this video will be focusing on investing within the stock market and how we can achieve success through the stock market. If you've come to this video specifically to see the stock market, and the third part of this video will focus on an in-depth lesson in how to invest in real estate. And the final part of this video will focus on investing in your own business. Now, this is just to give you an idea of the types of businesses that are very easy to start up, especially if you're doing it alone, and ways on how you can succeed in them. However, if you're here to learn about all kinds of investments, then I truly applaud you, because the best investor there is an investor who comes with an open mind and is willing to learn about all types of investment to really choose the one that works for you. And with all that being said, I hope you're ready to learn. And don't worry, at the end of this video, I will not be trying to sell you a weird course or a mailing list that I'd want you to sign up to. This is not how I work, and this is not what the video is about. This video is a purely educational video, and truly all I want is for you to be aware of your spending and learn how to invest your money instead of waste it. Because frankly, I don't want to see people broke when they're in their 60s and 70s, just like my dad. And this is the entire goal of this YouTube channel. I don't want to see people struggle financially because they didn't learn about investing when they were young. So I hope this video reaches as many young people as possible and teaches them about investing. And I just want to influence you to not waste your money and invest it, to have a better future, a better secure future where you don't have to work when you're 70. But anyways, that's... If you care about old people like this video, consider subscribing, because it really has taken me a long time to do this video and a lot of effort. Money, more money, more money, 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 more money, more money. Stock market, real estate, investing with Zane. Investing with Zane, so insane. Hey YouTube, what's up? I'm Zane and welcome to my YouTube channel. Today we're going to learn all about investing. But first, let's ask the question, what is investing? Now, investing, according to the dictionary, is to put money into financial schemes, shares, property, or a commercial venture with the expectation of achieving a profit. So, what is investing? For example, you have $1,000, which you don't want to spend. Instead of putting it into a savings account where it will decay over time, you decide to invest this $1,000. Now, investing is essentially allowing your money to go out and have a good time with other people's money. And then your money will eventually have its own money babies. So your money babies are profits you make from investing. And to top all of that off, when your money's babies grow up to be adult money, they can have money babies of their own. And it will be just a cycle of money making money to money making money, and before you know it, bam, you're a millionaire. All because you allowed your money to... What? Okay, so bad jokes aside, guys. Investing is where you put your money to work for you. Now, there are plenty of ways to do that. Some of the most known ways are through putting your money into companies as stocks in the stock market. Or perhaps buying real estate, which will give you profits in the form of rent. And this is when you become a landlord, which is an amazing way to make money. And we'll discuss it further in just a bit. And of course, the more money you have allocated to be invested, the more returns you'll be getting. Because normally when you invest money, you will get a percentage of that money back. So it's not like you can invest $1,000 and make $50,000 in a year. That's not how it works. You normally expect to get around from 3% to 12% returns depending on what you decide to invest. So that means if you invest $1,000, then you can expect to earn back between $30 and $120 in a year. And that's all coming from that $1,000 you invested. You don't have to work, you don't have to do anything else. This is your money making money for you. And this is amazing, but imagine instead of 1,000, you have 5,000 invested. And you kept adding another 5,000 every year. That means profit-wise, you'll have between $150 and $600 coming to you annually. And it will only increase the more you add money to fuel this money fire thing. So now that we kind of know what investing is, let's talk about how to get started and invest our money. Disclaimer, I'm not a financial advisor, but I know about money. Now there are two main ways to invest, and that is passive investing and active investing. Active investing is very much hands-on. This is where you're actively managing your money to help it increase in value. Now, the good thing about active investing is you can usually expect to make more money investing in a short space of time. But that is only if you know what you're doing, and a lot of people don't. And that's how a lot of people end up using their money in the stock markets. So I definitely, especially as a beginner, would not recommend that you start actively investing. For example, active investing is where you're in the stock market, day trading, buying stocks for a low price and selling them when they're high, making profits that way. You're checking your stocks all the time, you're reading about your stocks, and it's still just too much, especially as a beginner. So definitely don't take that route, but I'm still going to tell you just a little bit about it. However, another method of the active investment is starting your own business. Considering you know what you're doing, then you can pretty much double and triple and quadruple your money within such a short space of time. But of course, your capital is always at risk. So always be careful what you're doing, always do your research, and you're here watching this video today, which means you are doing your research. But I push you and encourage you to keep learning, and not just from me, from other people as well. Read books about it, watch other YouTubers, subscribe to this channel. So anyways, for me, starting my own business was how I was able to double my initial $1,000 invested. Now, I did this personally by buying products cheaply and then flipping them on eBay to make profit. So I do use the term business very lightly here because it wasn't a proper business where I had a shop or anything like that. But I did have an online shop on eBay, and I just bought products, flipped them for and I think the profit I made per product was 58% of the original price. So, you know, it was very easy to turn that 1,000 to 2,000. Now, it was products that I knew would sell for a higher price in the first place. I wasn't just buying anything that's cheap and selling it for an expensive price on eBay, because typically nobody would buy that. So definitely do your research before trying anything like that. The second type of investing is passive investing, which in my opinion is the best way to invest. You see, I'm someone that likes to lie around on the beach without a single worry in my head. And with passive investing, I can do just that. Because with passive investing, you really don't have to worry much about your money, because essentially your money is doing all the work for you. And this is one step closer to being financially free, which honestly should be everybody's goal. So to add another weird example to the table, think of investing like breeding dogs. Passive investing is where you leave your dog on a long leash and your dog can do their thing, and before you know it, boom, your dog is pregnant with a money baby. Whereas active investing is going with your dog on dog Tinder, trying to arrange dates for your dog, and just thinking of so many ways to get your dog. And in the process, you end up having to waste your own time going with your dog to doggo dates. You have to arrange the dates yourself. Sometimes you have to pay for the dog's dates, and so much effort.
Disclaimer, I'm not a dog owner, and those jokes are really terrible. I don't know why I'm keeping it, but I am.
Now that we know the two types of investing, let's dig in a little bit deeper on how to actually invest. Now, the types of investing easily available to you depend on your country. For example, if you're not in the UK or the USA, then investing in the stock market is still available to you, but it's probably harder to invest in it. By that I mean you'll probably have to pay a brokerage fee. Now a brokerage is basically like an agent, basically someone who will allow you to buy and sell stocks in the stock markets. However, they will usually take a fee from you in order to allow you to invest with them. They will take a fee when you sell stocks, when you buy stocks, and sometimes they will take a percentage of your money as well. Now the only problem with that is if you're starting small and you're only going to be investing $1,000, then a $5 fee is gonna be quite expensive. For example, if you're only investing $1,000, this $1,000 in a year will give you a return of 3%, which equals $30. And this brokerage fee is $5, then really in a year's time you've only made $25. So it really cuts your profits quite a bit. However, if that's the only option for you and you've done your research about the stock market and the specific stock you want to buy, then I would still recommend you start investing, because at least you're getting $25 at the end of the year rather than nothing. And if you don't know where a stockbroker is, all you have to do is get your phone and start Googling up and you'll find them. If you are in the UK or in America, then investing is as easy as eating beans. I don't know who says that saying, but investing is as easy as eating beans in the UK. Anyways, if you live in the US, then you're privileged enough to have many apps available to you, literally throwing themselves at you. And I'm talking about amazing apps where you can invest for absolutely free. Those apps include, but probably not limited to, Robinhood, Webull, and many more. And what better way to start investing than in the comfort of your own home on your phone? I hate talking on the phone, it gives me so much anxiety, and if you're in the US or in the UK, then literally with an app you can just buy and sell stocks. Ting, buy. Sell. Don't have to make any human contact, and that's why I love it so much. Now for me personally, I'm in the UK, and that means I don't have apps like Robinhood just yet. But good news, Robinhood will be coming to the UK soon, woo! And I am on that waiting list. But until it's here, I've decided to go ahead and start investing anyways. Now if you ask me how I invested my money in the UK, then I use the app called Revolut. Now I decided to invest with Revolut. Now it's absolutely free to invest with Revolut. If you have a standard account, you have up to 3 free trades every month. And if you have a premium account, then I believe you have 15 free trades every month. And if you have the metal card, which you have to pay quite a bit of a subscription fee for every month. But with that, you get free unlimited trades, which is amazing if you're a very big investor. Now Revolut charges me 1% on all of my invested money, but the stocks I decided to hold shares in give me a 3% return. So because Revolut takes 1% away, really I'm only making 2% a year in returns, which isn't really great, but it's not too bad either, and it's definitely better than just putting my money in a savings account and leaving it here to decay throughout the years because of inflation. So listen, no matter what, no matter where you are in the world, whether it's in South Africa, or whether it's in Zambia, whether it's in the USA, UK, anywhere in the world, literally just know that yes, you can invest. It may be slightly harder, but you can still do it. So don't be the first obstacle in your own way. Go out there and start investing now. Start investing today. There's nothing holding you back. Do your research and start investing. Now here's lesson number 2. The dividend stocks. Dividend stocks are stocks which pay their shareholders a percentage of their money back simply because the shareholders decide to invest in those companies. Those stocks will pay between 3% and 5% annually. And this is an amazing passive way to invest. Now, of course, in my opinion, dividend stocks are the best method to invest in the stock market. That is because even if the market does crash and the value of the stock becomes half or even less, it doesn't matter. Your dividend payments will still be the same. Now, of course, this is different from company to company, and you should always make sure to do your research before buying any stocks. Just do your research on that specific company. So we come to the second question: how do we know if this is a safe company to invest our money in? Now, to ensure a dividend stock is worth investing in, you should look into their dividend payments throughout the years. Throughout the market crash, especially the one in 2008, throughout good financial days, bad financial days, and all the tough times that the stock market has endured. If you can see that in the last 50 years, this company has kept a steady dividend payment to their investors, i.e. carried on paying dividends to anyone who invested even through the market crash, then this is probably a safe company to invest in. Now there's something called a company's safety score, and that tells you how safe it is to invest in each company. Now to help you understand safety scores better, let me just tell you that anything between 60 and 100 is considered a safe company. This means that even during a recession, a company with a 60 to 100 rating will still remain a safe investment and will carry on paying their dividends. Now, bear in mind that a company does not owe you any dividend payments. They're not actually required to pay you dividends. There's no law saying that they have to pay you dividends. There's no contracts or any obligations to them. So at any moment, technically speaking, a company can decide to cut their dividend payments completely. And this is why you should be very wary of investing in dividend companies with a low score. Oftentimes, companies can offer a 5% return on investment per year as a dividend payment, as a way to attract new investors who aren't necessarily aware. But this company cannot actually afford to keep up those payments. And once they have enough investors, they could decide to cut their investment payments just like that. Gone. So when investing in stocks, it is always best to follow the safety score you find rather than getting greedy on a higher return on investment percentage, because that might not be the safest thing and you might end up losing a lot more money in the long run. So again, always do your research before investing in any stocks. Now, good companies with a high score will go to extreme lengths to continue paying their investors, and that way they continue to grow as a company as well, which will benefit you, the investor, because that means your stocks will go up in value, and it will benefit the company because they'll keep on succeeding. It's a win-win situation. Now, companies with a safety score of between 30 to 60 are not necessarily bad companies. However, it just means that during a recession, those companies are more likely to cut their dividend payments. So my honest advice is, when in doubt, don't invest. Now, if you want to learn more about dividend investments or maybe day trading in the stock market, then do comment below and I'll be sure to respond to your questions, or I could perhaps make a whole new video addressing those questions specifically. Now here's the third part of the video and the second way to invest, and this is honestly my favorite part of investing, and that is through real estate. And in my opinion, it's the best way to invest, and it's also a much safer route to take than the stocks. And it can definitely offer a higher return on investment in a short space of time. However, while investing in real estate has a lot of pros, it also has a lot of cons. And one of the main cons is the fact that it's very expensive. In most cases, you will need between a 5% to 20% down payment on a house's price. Now, depending on where you live and how much house prices are, that could be from $5,000 to $50,000. And following that, you'll still need a high-paying job to be able to afford your mortgage payments every month. Not to mention the idea of having debt in your head, and that's not a small debt that can be paid off, but it's hundreds and thousands of money worth in debt. But guys, I don't want you to stress too much about, because now I'm gonna teach you about good debt and bad debt. Now, we all know what bad debt is, and oftentimes we associate the word debt with bad debt. We always think that debt is bad. However, that's not necessarily the case. You see, bad debt is your credit card debt or your car loan payment debt, which is essentially money you borrowed from the bank to pay for things that you don't need, like a new car, a new watch, a new laptop. You convince yourself that you need those things, but you don't actually need them. Good debt, on the other hand, is you smashing the like button. I'm just kidding, but please do like this video to show your support, and consider subscribing if this video is any help to you. Anyways, with that being said, good debt is borrowing money from the bank so you can make even more money for yourself and create wealth that way. Good debt is used to buy assets. Bad debt is used to buy liabilities. Now, before we go through with this video, I need you to understand the difference between an asset and a liability. Assets are things you buy, which work for you to make you more money. For example, if you buy a house as an investment, specifically to rent it out, then this house becomes an asset because the house is working for you to make you monthly income in the form of rent. Liabilities, on the other hand, are things that take money away from your pocket every single month. For example, your car is a liability. And I know you need to use your car to get to places, and that's fair enough, but that doesn't change the fact that it is a liability. That's because with a car, you need to continually pay fuel for it each week, you need to pay to fix it, you need to pay for insurance, you need to pay road tax, and so many more things, and it all adds up. And if you don't necessarily have a lot of sources of income, then that could really affect your cash flow, your monthly cash flow. So think of assets are things that throw money at you every month. That's right, every single month. And liabilities are taking money away from you and you allow them to do so because you convince yourself that you need those liabilities. But in most cases, you probably don't. You just need to make a shift in your lifestyle. To reach financial freedom and not have to work every day for the rest of your life, you need to have enough assets to be able to afford your liabilities or expenses. So you need to have enough invested money that brings money into your pocket every month to be able to afford your liabilities, such as the car, that take money away from you each month. And now that we know the difference between an asset and a liability, I want to share with you one hidden liability. One hidden liability that middle-class people usually purchase and think of as an asset, but it's actually a liability, and that is a house.
But you just said buying a house was an asset, so what the hell is that about, babe?
Let me just finish. Buying a house for yourself and your family to live in is not an asset at all. It's a hidden liability. That's because you'll be spending your life stretching all your finances and maybe even working harder for your employer in order to be able to afford your monthly mortgage payments every single month for the next 30 years of your life. And that is a long time. This house is not bringing money into your pockets, but it's actually taking money away from you. Money that you could otherwise have to invest in other things. A house that would be considered as an asset is the type of house that you buy specifically to be invested, that would bring money into your pocket through rents. But don't worry, of course there are ways to buy a house to live in where you can also sort of have this house as an asset. That can be done with a process called house hacking. House hacking essentially is buying a house or maybe even renting a house with 3 or 4 rooms. And what you can do is live in one of the rooms and rent out all the other rooms. In that way, and through renting the rest of the house, you're able to not only live for free, but oftentimes you're able to have a lot of profits coming into your pocket at the end of the month. Now, another way to profit a lot, and I mean a lot, through your spare rooms is by renting them on Airbnb. From Airbnb, you can charge similar prices to the hotels in your area, and that way you can triple your profits, honestly. Now, the Airbnb investment is what I'm currently doing in this house. And basically, to invest with Airbnb, all you need is a house which you're legally allowed to rent out. And considering Airbnb is legal in your city, then really all you need is to take photos of your house, post them on Airbnb, which you can even do with your phone, post them on Airbnb, and that's it, you're set. And simply sit around and wait for your first ever guest. From then on, after you have a few more reviews on your Airbnb house, you'll be able to get more Airbnb guests more easily and more often, which means more profit. Now, what makes Airbnb very attractive is because it gives you a more authentic look at the city you're visiting in comparison to a hotel. So if you have a spare room lying around now and you live in a city where tourists like to go, then I would definitely encourage you to consider renting out this spare bedroom on Airbnb. It's an investment that I can guarantee you will not regret, as long as you are careful who you allow into your Airbnb space. However, let me just warn you and say that Airbnb as an investment would be considered an active investment. That is because 9 times out of 10, you have to be checking guests in, you have to be checking the guests out, you have to clean the room and the house before they come in, after they leave. And if this kind of effort isn't something you're after, then let me talk to you about buying a house as an asset, which is definitely less work throughout the years, but it's a lot of work at the start. However, this work at the start definitely does pay off. Now, an asset house is a house which you buy through a traditional mortgage, specifically to rent out. Now, let's say you buy a house for $150,000, and you have a down payment of $15,000. This is your typical 20% down payment. Following this 20% down payment, through the months you'll have to keep up paying monthly mortgage payments. Now, the mortgage payment on a house like this will be around $640 per month. But if you imagine this house has 3 rooms, and depending on the area, you could potentially rent each room for $350, making you a total of $1,100 every month. Or you can simply rent out the entire house for a family for probably around $1,000. Now, your monthly mortgage payment is still $640. Yet this house is putting $1,000 in your pocket every month. So that means this house gives you profits of $360 every single month. And here's where it gets interesting. Imagine saving this $360 every month, and over time you're able to afford 3 houses that each pay you $360 per month. That makes your profit of $1,080 every single month. That's with you not having to do any type of work whatsoever. You just have houses that work for you and bring you money. Now, of course, the house will break every now and then, or something will happen, but I personally don't think that's a big issue. Now, that is not to mention the appreciation of those houses. Now, I hope the entire assets and liability thing is starting to make sense now. This house is an asset because it puts money in your pocket every month, whereas a house you buy simply to live inside is not an investment, it's not an asset, it's a liability because it takes money from your pocket every single month, and you have to continue to work in order to afford those mortgage payments. Whereas an asset will work for you to the point where you can retire early from your job because your money is essentially working for you to the point where you don't need to be physically there anymore. So getting a mortgage to buy a liability is generally considered bad debt. Don't do it. Whereas getting a mortgage to buy an asset is good debt. However, getting a house to live in my opinion, is still a better option than paying rent. Because again, with appreciation, the house can raise in price, and you could always sell a house if you need your money back. Whereas money spent on rent is technically wasted money because you don't have it anywhere, it's gone. It's simply money that you will not get back. Now, imagine today you were renting a house, and today also you lost your job. It's a pretty bad day for you, man. And you have no savings whatsoever. If you're not able to come up with a rent payment by the end of this month, then you're kicked out and you're basically homeless. However, instead imagine that you owned a house today and you've been contributing to your mortgage payments every month for the past 10 years. Today you also lost your job. Sorry about that, mate. And your house over the last 10 years has appreciated by, let's say, 10%. Now, you lose your job and you also have no savings, which honestly, you should have a saving. Now, when you own a house, you have 3 options you can do, and it's definitely better and safer than having a place that you rent. Number 1, you can rent a spare room or Airbnb. Sometimes if you rent one spare room, you could potentially make up the entire month's rent from that single room, of course depending on your area. Number 2, you have the option to rent out your entire house and perhaps live at a family's place for a short time. And 3, and most importantly, you can sell your house and earn all that money back which you've invested into the house. So technically, money you pay into a mortgage for a liability house is not necessarily lost money. However, it's also not the best investment. So if you had to choose between renting and buying, I would personally recommend buying. But if you had to choose between buying an asset or buying a liability, then definitely buy an asset. Considering you have a 20% down payment for a house, and if I were in your position, I would buy a house with 3 rooms to live, and I would rent out the 2 spare rooms on Airbnb. This again is called house hacking, and I would keep house hacking my way through this mortgage payment until I'm able to afford my second home. I'll be able to afford the second house by saving a 20% down payment.
If you've made it this far in the video, thank you very much. I know it's actually a pretty bad video. Everything about it is not great. It's scripted, but it's really, really scripted that I kind of hated it. So much so that I didn't really want to edit it much, so it's kind of just a raw video. It is still educational, so if you've made it this far, thank you so much. Have a good day, and I hope you subscribe. Peace out.